Alright friends, I am sure you have completed writing these 5 steps. So as I have mentioned earlier that writing these steps is okay, but you need to understand the application of each of these steps. So we begin with the first step, that is identifying the contract. So it all begins with a contract with the customer. So it is always the terms and conditions of the contract that will provide you enough information with respect to multiple aspects, like all steps, identifying the performance obligation, the transaction price, everything will be based on the terms and conditions of the contract. So it is very, very important for you to first identify the contract with the customer. So let us go little deeper into this. I want you to write this heading in your notebooks, that is identifying the contract as step 1. Quickly write this heading, identifying the contract, and then within this step we would say only when an arrangement with a customer meets each of the following criteria. So whatever criteria we are going to mention over here, each of the criteria has to be met. That means if any of the criteria is not met, please understand one thing, then it will not be considered as a contract with the customer, and henceforth IFRS 15 cannot even apply. So to application of IFRS 15, the basic condition is there has to be existence of contract. Let us look into these conditions. The parties have approved the contract and are committed to perform their contractual obligation. So it could be this way. Suppose you and me, we have entered into an arrangement. You offered me that, sir, I want CFA level 1 class. Will you train me? I said, let's begin with something and let's see how it goes, and then we will decide. That means I'm not showing my commitment to the contract, right? So when there are loose ends like this within a contract, you cannot even call that as a contract. And believe me, when there is no contract, there's no question of revenue recognition. It cannot even start. In simple words, there may still be revenue, but you cannot recognize the revenue as per IFRS 15. IFRS 15 emphasizes fulfillment of these conditions. Second thing, the entity can identify each party's right regarding goods or services to be transferred. So when we are identifying the terms and conditions of the contract, so if the contract is between you and me, you being customer, I being the service provider, we need to look into what are my rights and what are your rights, what are my obligations, what are your obligations, and are we able to identify each party's obligations as well as rights. That is a very, very important condition for a contract to be coming into existence. An entity can identify the payment terms for the goods or services to be done. So what will be the payment terms? Whether the payment has to be made one shot, whether the payment will be in installments, what will be the payment terms, that also has to be mentioned. So what will happen later stage when we bring components like significant financing component, it will all have connection with this particular step. So you please understand one thing, your consideration and allocation of that consideration has a lot to do with each and every point of condition that you are coming across over here. As a result, this first step is the most important step, because if this is not clear, there will not be any contract emerging between the supplier and the customer. The next condition is the contract has commercial substance. See, commercial substance is very important because we are talking about revenue recognition. See, it is not necessary that any activity performed by someone will always be targeted for revenue recognition. For example, if you can see, I have this equipped studio with me, and here I record my classes with a commercial substance, with a commercial objective. I record my classes for the purpose of sale, for the purpose of generating revenue for myself. Now, is that the only use of these assets? The answer is no. For my other leisure activities like playing some musical instrument or recording my voice as a vocals while singing, I use these same equipments, but when I am doing those activities, I do not have any commercial substance or a commercial objective. As a result, those activities cannot constitute to a contract with anyone where the commercial substance is missing. So presence of commercial substance is important, and it is probable that entity will collect substantially all of the consideration to which it expects to be entitled. See, whatever consideration is fixed between the customer and the supplier, the entity should be having a probable chance. Probable word has some specified meaning. Generally, I would say the term probable is defined in standards like more likely than not, means it is more likely to happen than not to happen. That means in order to quantify something that has a probability greater than 50% can be considered as probable. However, let me tell you, when it comes to application of IFRS and the US gaps, they both have similar conditions, but you should know one thing very well. The word probable has been defined differently under IFRS and US gaps. Therefore, in exam, if there is something with respect to a question where the word probable has to be interpreted, you should always look into the question. Is the question being designed from the angle of IFRS, or is the question designed from the angle of US gap? Because the term probable has different meaning over there. So what I'll do is, before I take you any further, I give you a chance to quickly take note of these points and then we move ahead. Alright friends, once you have completed writing this much, let us move ahead and note down one more important point. Collectibility must be probable for a contract to exist, but probable is defined differently under IFRS and US GAAP. So an identical activity could still be accounted for differently by IFRS and US GAAP reporting firms. Please take note of this line as well, and then I take you ahead. Alright friends, once you have completed writing this small paragraph, let us move ahead, and now we deal with the second step, that is identifying the performance obligations. First of all, in this title, the use of the word obligation is in plural sense. That means it itself emphasizes that obligation may not be a singular obligation, it could be multiple obligations. Let me tell you one thing very clearly, that when an entity is supposed to recognize revenue, it has to do something. It has to either supply goods or provide services or do something to recognize its revenue. Now, let me be very clear on this. There may be multiple ways of recognizing revenue. For example, I have a property which I am allowing you to use on rental basis, and you would pay rent to me on a regular basis. Isn't that a revenue for me? It is a revenue, but it doesn't constitute under revenue recognition as per IFRS 15, because that is a different kind of income. It is a leasing income that I am earning, where I am a lessor and the counterparty or the customer is the lessee. So please understand, it is also revenue, but it is a lease revenue. It doesn't come under these conditions. Let us take one more example. I have lent you, say, $50,000 for a period of 3 years, and on a regular basis with quarterly intervals you are supposed to pay interest to me. Now, payment of that interest is your expense, and for me definitely it's an income, but that doesn't come under revenue recognition as per IFRS 15, because it is an income under a different head, what we identify as financial instrument. Because when I have lent money to you, it is a financial asset for me and a financial liability for you. For you and for me, it is IFRS 9 that we have to follow. That means it will be a different set of standard applicable for financial instruments or financial assets and financial liabilities. That is why here we are emphasizing on one thing. It has to be a revenue arising out of sale of goods or provision of services. So you cannot bring in examples of giving loan to someone or letting out your property on rental basis to someone or letting out any other asset by usage by some other entity which will generate some kind of income for you, that revenue recognition has nothing to do with IFRS 15. As a result, here we are pinpointing our focus on only two aspects: transfer of goods or transfer of services, or sometimes both. Now what happens? When you subscribe for my CFA level 1 course, what all is given to you could be constituting goods as well as services. So I will provide you some reference material in the form of printed books. I will provide you these recorded videos. I will provide you online doubt clearing sessions. I will conduct a test series for you. All these are what? My separate performance obligation. Now I am going to design different structure for you. CFA level 1 regular course, CFA level 1 premium course. The premium course will offer multiple aspects like online doubt clearing sessions, which will be in a bigger frequency compared to those which are benefited for the level 1 regular students. Now there will be a separate test series which will be included as part of the premium package. So when you are buying the premium package, you are putting more obligations upon me, because I am the service provider. I will identify that, okay, you are a premium candidate, so that I need to have all these obligations for me to perform for you as my client or customer. And therefore, identifying that for which customer, what are my performance obligations, it is very, very important. So something has to be done to generate revenue. Whatever is needed to be done for generating revenue is what we identify as performance obligation. And as I said, there can be a singular performance obligation in some cases, or there could be multiple performance obligations in some other cases. Let us now go into deeper aspects of this second step. So you would have written this heading, step 2, identifying performance obligations. A contract at the point of its inception will require an entity to assess, number 1, goods or services promised in a contract with a customer, and shall identify performance obligation under each promise to be transferred to the customer. So for each goods or service that I have to provide, what will be performance obligation with respect to that particular good or service? That means if there are multiple goods or services offered, then performance obligation needs to be identified for each good and service separately, because it is a multiple set of goods and services offered. As a result, there has to be performance obligation identified for each separately. Performance obligation has been defined as a promise in a contract with a customer to transfer to customer either goods or services that are distinct, or a series of goods or services that are substantially the same and that have same pattern of transfer to the customer. Now see, goods or services that are distinct. For example, my video lectures and my test series, are they distinct or not? They are distinct. So if someone doesn't want the test series, they may opt for removing that as a feature, and they may end up paying lesser amount of fee if they are not opting for the test series. Correct? However, suppose you enter into a contract with a supplier for supply of goods on a regular basis for a long term. In that case, the supplier is going to follow a series of commitments. Maybe every month the supplier is committed to supply something. So that commitment goes over a period on a uniform basis, and that can be having the same type of performance obligation performed over a longer period. So it could be either the same activity on a recurring basis for a long term, or it could be one-time contract, or it could be a contract where multiple performance obligation exist, or multiple provision of goods and services which are distinct. So keep one thing in your mind, whenever you are going through any of these conditions, what is important? The usage of the words and or. So when I am giving you these notes, notice one thing, I either put and, or I put or when I have given you a series of condition, I have highlighted all of the conditions, all of the following situations, or all of the following criteria. Please keep one thing in your mind very clearly. Sometimes it is either or sometimes it is all the given points need to be considered to fulfill the criteria. And that is where your understanding will be tested by the examiner. Examiner will put, say, these two conditions in a question and say the contract is giving either this or this. Will it be fulfilling the condition? Then you should know as a student that okay, either of these conditions need to be fulfilled. So any one fulfilled, it is okay. That means your answer should be stated accordingly. So imagine what happens on the examination day when you're sitting in examination hall and you have not taken care of the words and or. You might recollect that okay, there were 2 points, here it's only 1 point which is applicable, so this may not be the criteria. You may end up losing marks over there. So be clear when you are writing notes. Take one extra effort where I have used a different color. You also can use that different color to identify what exact words we are writing. So I'll just give you an opportunity to take note of these points and then we move ahead. Alright friends, once you have completed writing these points, let us move ahead and we talk about distinct performance obligations. A good or service that is promised to a customer is distinct if both of the following criteria are met. When I say both of the following criteria are met, means I am going to put forward 2 different criteria, and you should be mentally prepared that the word that I am going to put between point 1 and point 2 will be not or but and. So customer can benefit either alone or with other readily available resources, and such good or service or such goods or services are separately identifiable from other promises in the contract. So please understand. When I say that you have taken CFA level 1 premium package, the package offers you printed books, the package offers you recorded videos, it offers you online doubt clearing sessions, it offers you test series and some other features. Now each of these aspects will be mentioned because when student will be visiting my website, student will be identifying that okay, we have 2 different alternatives available, the regular package, the premium package. So what is the difference between the two? So we generally provide that in a columnar way, that okay, these are the different features that we provide. Many a times what we do is when we find that a student has chosen the regular package and later on the student wants to upgrade into the premium package, we allow them to pay the differential amount of fee and we upgrade the students into the premium package. When we do this, we need to have a clear demarcation between what is the good and service that we are going to provide in the regular package and what are the goods and services that we are going to provide in the premium package. And that is why distinct word means whatever goods or services I am giving to you as a supplier, you can use it with your other readily available resources. You don't have to depend on something else. Then it is a distinct performance obligation. Now see what happens. Suppose I have made a contract with you that I'll provide you a car along with a chauffeur. So chauffeur will be provided along with the car, that is the contract. If only car is sent to your place, the performance obligation isn't complete because you cannot use that car without the chauffeur. You will be waiting in that case until the chauffeur has arrived. The obligation from my end will not be fulfilled. That is why without depending on anything else, are you able to use that good or service on a standalone basis? If yes, then it is a distinct performance obligation. Are we clear on that? So look at one thing. Such goods or services are separately identifiable. You should be able to separately identify, for example, if you want multiple cars, then okay, you give me this car, you give me this car, you give me this car. I have a fleet of vehicles available with me. What contract you have made with me, if that is asking me to provide multiple goods and services on maybe, rental basis to you. In that case, though it could be an example from the viewpoint of lease, but just for sake of giving an example, I am telling you that if I am providing over there multiple goods or services, in that case, are you able to identify each as distinct or not? So how do you identify something as distinct? So condition number 1 is the customer should be able to use it without depending on anything else, with the sources, or I would rather say with the resources and assets available with the customer already. And the second condition is it should be separately identifiable from other promises in the contract. Means other promises in the contract should be distinct. For example, again, if I get back to the example that I have offered to you, like in the premium package, offering the feature of test series is a distinct product. Separately, someone can join only for test series. So if you are taking the premium package, that service will be included within that. That means it's a distinct performance obligation, an example of distinct performance obligation. So quickly take note of these points and then I take you ahead. Alright friends, once you have completed writing something about distinct performance obligations, we move to the third step, that is determining the transaction price. So please write up this heading in your notebooks. Step 3, that is determining the transaction price. Under this heading, let us look into what is the basic crux. When a performance obligation is satisfied, an entity shall recognize as revenue the amount of the transaction price that is allocated to that performance obligation. Now these are exact wordings of IFRS 15, and I want to explain the third step, but what I am trying to do over here is I am first bringing the need of this third step, because if you focus on those pointers which are mentioned as a basic revenue recognition criteria, look at the language of these words. When a performance obligation is satisfied, that means they are telling you on completion of fifth step, what an entity has to do? An entity shall recognize revenue. But recognize as revenue what? The amount of transaction price. So you cannot be vague or loose about anything. You have to be very, very specific that if at all someday you are fulfilling all your performance obligation, you will go for revenue recognition. But how much money as revenue you will recognize, you should know that it has to be the amount of transaction price. And again, I am telling you, if the contract includes multiple performance obligation, then before going for revenue recognition, you have to look into how much of the transaction price is allocated to each performance obligation. So logically, if you master this particular aspect in your mind, you will understand the logic behind those 5 steps, those 5-step model. And henceforth, what we are now focusing now is on the meaning of transaction price. The transaction price is the amount of consideration to which an entity expects to be entitled in exchange for transferring promised goods or services to a customer, excluding amounts collected on behalf of third parties, for example, sales tax. Now look into one thing. In different countries, the pattern of collecting indirect tax by government could be little different. Say in a country like India, it is GST, goods and service taxes. In the US, it is simply sales tax. So if I restrict my examples to the scenarios in US, I would say sales tax could be an example where if I am selling some goods which includes a price, for example, the goods are priced as $89 inclusive of all taxes, means it includes sales tax. So if the price is $89, it is including sales tax to the extent of say 5% or to the extent of 10%. Then I know one thing, that from the customer I have collected $89, but 10% of the transaction price is going to be sales tax, which I have collected on behalf of US government, correct? Which I cannot keep it with me. I have to pass it on to the government because that is a sales tax that I have collected from the customer. Now, what has to be done? If I am collecting sales tax and it is included in the price, that money is not going to come to my pocket as a whole. Therefore, I must know that when I am raising invoice, it is inclusive of sales tax. So I should split how much was the revenue in that invoice plus sales tax. That aggregate is $89. Therefore, my revenue is not $89. My revenue is the amount prior to adding the sales tax. I'm sure you are clear with this point. So let us quickly take note of this initial part, which is very, very important line as per IFRS 15 and the meaning of transaction price. Take note of this and then I take you ahead. Alright friends, once you have completed writing this whole thing, let us move ahead and write something more. A transaction price is usually a fixed amount, but it can also be variable. For example, if it includes a bonus for early delivery. A firm should recognize revenue only when it is highly probable that it will not have to reverse it. In determining the transaction price, an entity shall adjust the promised amount of consideration for the effects of time value of money if the timing of payments provide the customer or the entity with a significant benefit of financing. So let us discuss this whole matter in little detail and then I'll give you time to write it down. First of all, the initial part over here indicates that the transaction price may be a fixed price and sometimes it may include a variable component. For example, if I am a construction contractor and the total price agreed for the entire construction work when I fulfill my performance obligation is suppose $40,000, but I have been given 6 months time to complete the contract. For any delay beyond 6 months, per day I tend to lose say $120. In that case, my contract price or the total transaction price may not be the amount that was negotiated as a fixed amount. Sometimes I may have to compromise with a lesser revenue because I have to bear that penalty if I make delays in the contract, and the same contract at the same time also provides that if I do it early, for any day, for every day that I have completed the contract before the due date, as a bonus I'll be given $50 per day. In that case, suppose I end up completing the contract 8 days prior to the designated deadline, then 8 days multiplied to $50 per day, I will have an additional variable revenue of $400, correct? In that case, the contract may provide for a variable component as well. Now, most important thing is, when should you recognize a revenue? When you are finding it highly probable where you don't have to reverse that revenue. For example, at the very early stage, I am confident that being a construction contractor, I will complete the task 8 days before the deadline. Based on my past experience, I am so confident. But my confidence cannot be brought in my accounting records. Accounting records will ask me to stay put, look at the terms and condition of this particular contract, look into the how performance obligation is being settled out, how the entity is exactly performing with respect to this, because in the whole matter there may always be uncertainties. So when you are not certain about any revenue to arise, you better don't recognize it. So you wait until it is highly probable that yes, you are going to get. So when should it be the right time? For example, the deadline remaining for the contract is say 15 days. And I know one thing, that for me to complete the remaining activities, it may just take another 5 days. For safety, I am putting additional provision of 2 days. I am now 100% confident that there will be 8 days of time that I will save. And I know that on each day basis, I will be awarded with a bonus of $50. Now when I am 100% confident about getting it, where practical situations, current situations are allowing me to acknowledge that yes, this is going to happen, then I can consider my entire revenue based on that bonus element as well. But until it is highly probable, we are not supposed to recognize that revenue. See, standard is not asking you to wait till end and then only recognize. Standard is allowing you to based on your estimates also, but it should be highly probable. Now, the last paragraph over here is very, very important. Guys, understand one thing. In your curriculum, they haven't talked about more examples of this particular aspect. So I'll just give you a couple of short examples to convey this. Say, I have provided goods to the customer already, okay, and customer is allowed to make payment after 1 year. I have provided the goods to the customer, but customer hasn't paid me right now. Customer is being allowed to make payment after 1 year. Now you tell me, in general practice, do we find 1 year of credit period ever offered in general business practice? May not be. Particularly, suppose in my example, it is generally 15 days of time that I am offering to all customers, and one particular customer in my case is a customer to whom I have offered 1 year time. Standard says, boss, whatever you consider, we know one thing, if the market reference rate is 10%, then what customer is ultimately going to pay you is the transaction price plus 10%. So whatever price is paid by the customer is actually 110% of the transaction price. So you would want to find out how much is the financing component over there that will be recognized as my revenue under IFRS 9. And the real transaction price will be recognized as revenue as per the IFRS 15. Why? Let me explain it this way. Let us suppose that the total transaction price after accepting the payment in 1 year time is say $55,000. For simplicity, I have picked up the figure $55,000. If I say that it is the transaction price plus 10% means $55,000 is 110%. So obviously how much is 100%? Without using calculator you can conclude that it will be $50,000. So basically the total amount that the customer is going to pay to me will be $50,000 towards the transaction price and $5,000 towards the late payment, because that was never part of the general terms of business to provide 1 year credit. So standard says that boss, you are going to receive $55,000, that is fine. We would want you to split that into the real proper transaction price, because what if the customer would have paid instantly? What if the customer would have paid instantly? Will you still charge $55,000? Answer is no. In that case, you would have happily offered the price of $50,000. In that case, $50,000 is the right transaction price which will be recognized on fulfillment of performance obligation as per IFRS 15. Whereas when you recognize the interest component as your income, it cannot follow the performance obligation completion as per IFRS 15. Then it will be a revenue separately recognized under IFRS 9, because there it is a financial asset in terms of accounts receivable, where you are charging interest income, and interest will accrue with the passage of time. So until the time has passed, interest income cannot be recognized, and therefore you wait for that $5,000 to first accrue, then you recognize. However, if I have already provided the goods, customer is going to make payment of $55,000 after 1 year. How much revenue can I recognize right now? Excluding the financing component of $5,000, remaining $50,000, to that I have fulfilled my performance obligation already. It is probable that I will collect that money. Nothing can stop me to recognize an income of $50,000. That will be the transaction price. But I should avoid recognition of that $5,000, because over there my performance obligation of supplying goods is not the condition, because that's a different type of revenue. It will be recognized as per IFRS 9, not as per IFRS 15. So I'm sure you are able to understand what I'm conveying. Please write up these points and then I take you ahead.